Now let's talk about inflation. Inflation has very big effects on the economy. One of the main effects that it has is that it impacts interest rates. So when we borrow money or when we loan money, we take into consideration the inflation. And so the interest rate that we're quoted at the bank or that's out there being used is the nominal interest rate. That's the interest rate you actually get quoted. But that's not the real interest rate. The real interest rate is adjusted for inflation. Now, for many, many years, economists said banks will never pay negative interest rates on deposits. That's just not going to happen. Banks will always pay a positive interest rate. And so we never really considered it until a few years ago in Europe, a bank decided to offer their depositors a negative interest rate. In other words, put your money with us, we'll take some of it, and then we'll give some of it back to you. Well, obviously, they didn't want the money to be deposited. And so people didn't deposit the money there. They took it out. But the government was hoping that they would spend it on consumption. But as we've learned, consumption is sticky. So what did the people do with that money? They deposited it in banks in other countries where they could earn a positive interest rate. So it didn't help them, so they stopped paying the negative interest rates. However, is it possible that you could be paying a negative real interest rate on your deposits? That's an important question. And the answer is yes. In fact, it's happening right now. Think about this. Inflation is 2 to 3% a year. And the banks are paying 0.1 interest rate. So at a 2% inflation rate, and you're only getting 0.1 interest, you're actually earning a negative 1.9% interest on your deposits at the bank in real interest. So inflation has an impact on us and on interest rates. Now, inflation also creates transfers between people. You see, lenders suffer because they loan people money at a certain rate. If the inflation rate increases, their return goes down by the inflation rate. It could even become negative. Borrowers gain. If borrowers borrow money at a particular interest rate and then there's inflation, they're paying it back with inflated dollars. So why would we have an inflation rate benefit borrowers? So the question is, who is the greatest borrower in the world? Who borrows more than anybody else in the entire world? And the answer is the United States government. So the United States government likes some positive inflation. It's good for them. Now, inflation also generates other costs. And we have some names for these. One of them is menu costs. It's not really about menus, but we use menu cost to express the kind of cost it is. In other words, if you go to a restaurant and they have a menu, somebody had to print that menu, and there was a cost to figure it out, and the price of the meals and so forth. And if the inflation changes the prices, they have to throw that one out, print a new menu. So there's a cost associated with changing the prices on things. When I was young, in the grocery stores, they had a little machine they would use to put a sticker on all the canned goods with the price on them. And they had to go through it. Every time there was a change in the price, they had to go through and put new stickers on all the cans because the prices went up. That's a menu cost. Of course, today we don't do that. It's changed once in a computer. That means it's not that costly. The other cost we call shoe leather cost. Well, what is shoe leather cost? It's the cost of having to go to the bank more often because you need to take money out of the bank. Today, we don't really worry too much about shoe leather costs, but when you have hyperinflation, it can have a big impact. During the aftermath of World War II, the Germans were suffering terrible inflation, and the employers would have to pay their workers twice a day because the money was changing in value so much that they demanded to be paid twice a day. So they got paid at noon and then once at the end of the day. So they would get this check for their first half of the day's work, and they would run over to the fence and they would hand it through to one of their children. The children would run down to the bank, cash the check, and then take the money out and make the purchases for groceries and food before the prices went up. And they'd do the same thing at the end of the day. The prices were changing so rapidly that it was necessary for them to do that. So that's shoe leather costs. So what's better, inflation or deflation? Or maybe no inflation? Well, people are afraid of deflation. They don't see the government particularly is not fond of the idea, because that would mean it would have to pay back its debts with greater money with greater value. But they argue that deflation would cause people to postpone buying things. I'll postpone buying this because it's going to be cheaper next week. I'm not going to buy this new car because next year it will be 2% cheaper because of inflation. And so they argue that deflation is a bad idea because it slows consumption. Now the question is, does a 2% annual deflation really impact purchases and the decision to purchase? Probably not. But nevertheless, that's the government's argument, and they want a bit of inflation. So one of the things that the Fed has been asked to do is to create a steady inflation of approximately 2% a year. And that's where we stand with the Fed. Now, one last thing that I need to talk to you about is, what if the banks fail because of solvency? So we're covered if there's a run on the banks, if there's a liquidity problem, no problem. But what if the bank becomes insolvent? What happens to our deposits? Where's our money going to be? Remember, we want a stable banking system that makes us feel good. Well, to solve that problem, we created another private corporation, which is an insurance company. You've probably heard of it as the FDIC, the Federal Deposit Insurance Corporation. The FDIC is tasked with selling insurance to all the banks so that if one of them goes bankrupt, it will cover the deposits. And currently, the deposits are covered up to $500,000 a year. They increased that recently with the last recession. So if you have $500,000 or less in a bank, then your money is secured by the FDIC.